Hello and welcome to the Trading Bell. I'm Nokip Kimbo, and today we are talking about the markets. I know the year is pretty young. You want to know what exactly is going to be happening in 2023. We do not claim to be prophets, but based on what happened in the year 2022, we can at least project on what 2023 portends. I'll be having a chat with Gregory Waweru, the Chief Executive of SBG Securities. Welcome to the show, Gregory.
Thank you, it's a pleasure.
Yeah, so looking at the Kenyan market, we're just starting the year 2023, but 2022 is that year that had so many lessons. For starters, it was poised as the year of recovery, because the impact of COVID in 2020 sustained in 2021. 2022 was sort of the bounce back year. Then we also had another factor. An election came in play. Then we had the Russia-Ukraine situation. So many headwinds. By the time we were closing the year 2022, looking at the markets from where you sit, what were the greatest lessons that we could pick from that particular year as wavy as it was?
Yes, thanks. No, I think it was a tumultuous year in all aspects. I think what we can draw from it is that global shocks have significant impact on our markets beyond what we may be perceived, we may perceive as beyond what we may perceive beyond the local events. For example, the elections that you did mention. As a consequence, I think it's very important to put into context the influence of global events into our local markets. You did see, for instance, last year, there was quite a lot going on, and this goes beyond the Kenyan market. A lot of markets closed in the red. It was very clear inflation was a very dominant theme through 2022, which led developed economies to raise their benchmark rates, which again triggered the capital flight that has eroded a lot of the gains that we've had in prior years. So I think in a nutshell, the situation is such that global events have a very dominant impact on our markets today, and I think that's the current construct, which maybe we need to also look at in terms of how the composition of markets in terms of trading activity between local and foreign does play out in the markets.
Definitely. Yeah. I'm glad you've brought that issue in terms of composition, which has been a huge issue right here at the NSE. Local players vis-a-vis, foreign investors. And we see this during election years, they hold back, they pull out. And now with, the rates being hiked at an ever-increasing rate in the States, even more pull out in some of these, upcoming markets, nascent markets. Locally, how can we build that local investment curve to be able to see sort of stability amidst global turmoil, at least to have your own within your market?
Thanks for that. It's an interesting question because I have long held the view that the domestic investor base gives you an anchor in challenging times, and I think that is very clear from the evidence that we observed from 2022 in terms of market activity and the interplay between foreign and domestic investors. I think you'll appreciate that we've had foreign investors dominating, for instance, average daily trading volume activity at the NSE, and as a consequence, that has had an impact in how, for example, price discovery takes off, or vice versa, and I think that is really the crux of it. In Sub-Saharan Africa, typically we've seen much lower domestic investor participation, compared to, for example, some of the North African countries like Morocco and Egypt, where the domestic participation is much higher than even in some cases higher than foreign. And I think that is really the important point. Again, in situations where global shocks are being experienced, the foreign investors will naturally look back to their own markets when there is a risk-free sentiment across the board, and I think that is that's the reality we face today.
And I mean, looking at majority of our counties here at the NSC, we don't have so much fluctuations. So in terms of capital gains, making money from trading stocks is a little bit limited. Majority of people, wait on dividends, look at dividend shares. But also that was hard hit during post-pandemic era, the year 2022. Almost half of the counties, they didn't issue a dividend. In terms of the strategy to approach investment in equities out there in this year, is it something that we need to have a different approach? Is there a better approach to it?
I think it's an important question, and that leads me to think that investors need to be a lot more selective when picking assets, and I think this is very clear because there are those that seek dividend returns, in which case they will have the propensity to invest in high dividend yield stocks. There are those who seek capital gains. And remember, we are largely a long-only market, meaning investors only benefit when share prices actually rise. We don't have a shorting really taking place at the moment. So I think the lesson is that investors need to look at their own circumstances and figure out where the benefit is. And clearly the dividend stocks tend to have quite a bit of an attraction, and the high dividend stocks tend to have some defensive qualities which investors do like, particularly because that provides a cushion when the markets are not particularly performing well.
Yeah, definitely. So you talked about sort of having more local participation. Yeah. And this has been a talk even from the top office in this country, sort of democratizing participation in the stock market. Yeah. The president famously put it, tunataka mama mboga akue pia amenunua shares, to be able to reach at that particular level. Yeah, I know technology is one of the avenues that has been poised as a vehicle for this particular change. Do you think that can accelerate, and what do we expect in that field in the year 2023?
Certainly, technology can accelerate it. We can have a tech-led strategy, but I think the other important element is actually to educate and to support the investing public, to broaden it in all aspects. I think you need to democratize, at every level. Now, the bigger question is, do we have an ingrained savings culture, or an investment culture outside the traditional asset classes such as property? Because I think that is where people do invest, but the question we are asking today is what can be done to crowd in these investors into the capital markets, and I suppose that's a $1 million question. So I think it will take a combination of successful strategies that will address both the demand side from the investor standpoint and the supply side from an issuer standpoint. I think we need to continue having high quality issuers in the market, of which we do, and even for the future, for bringing new IPOs and listings to the capital markets. But at the same time, we must figure out how to crowd in these investors and making it easy for them to invest, making it as easy as possible through technology, through education, and how to support them make investment decisions, and more importantly, change the investment construct, not to be only real estate, people looking at plots of land, but also looking at other ways of enhancing their portfolios. Yes. I think that is really the solution, and to think about, to encourage investors to not so much think only about allocating assets, but also allocating risk
Yes.
across the various asset classes.
And looking at investment as a phenomena, yeah, because sometimes we talk about democratizing and making it so easy to participate in the stocks, for example. Somebody says the cost of living, inflation, all this is eroding into what I would have put there. So in terms, even on a macro level, as a country, is there things that we need, some bolts that we need to tighten to make sure that the after effect is that people are gaining more interest on top of, better education and information and, knowing and technology also being used? Are there some of these macro elements that we need to tighten to make sure that at least we are having a more vibrant market?
Certainly, the propensity for investors to save and invest is also driven by the level of household incomes. And I think in today's world where inflation is a concern, that does have an impact on people's discretionary incomes. Some of them are still eroded post-COVID, and I think the repair is still somehow taking place in certain aspects across certain sectors. But the important thing is to say that it has to be seen as a journey. And what do you need to do to stimulate savings? What do you need to do to stimulate investments at domestic household levels, to crowd in investors, individual investors meaningfully? I think that is really the question. So solving the macro fiscal challenges of today and navigating them successfully in a way that stimulates growth of incomes is quite crucial. Therefore, to ensure that in the long run, investors will continuously look to invest in the capital markets.
Just recently, we've seen a raft of new taxation measures that have come at play. Talk about capital gains tax, and everyone was waiting what will happen for those who trade a stock and they're gaining something from it. I think that was exempted. In terms of the policy environment, are there things that we need to be, or areas that we need to be very careful about in 2023, sort of change to make the policy environment more healthier for investors?
I think so. Look, I think there are already some incentives for companies to list in the markets. That's there. But the question the broader question is, what incentives are there for investors to save through the markets or to invest through the capital markets? I think those are the things that need to be very well perhaps understood, so that and facilitated actually from a policy standpoint to help pull in these investors outside what is currently available. So it is crucial, therefore, that the policy environment remains very, very supportive for new issuers. But also, I think the bigger problem we have today is on the demand side, that we have not managed as a market to encourage broad-based participation, which I think will be the next frontier for the markets as a whole.
Definitely. Normally, I listen to the CEO of NSE, and he's always talked about equities being that undiscovered gem in our markets, because there's a huge propensity towards fixed income. And looking at the rates in the fixed income, category, I mean, very, very encouraging for people to put their money there. In terms, first of all, fundamentally speaking, what should be the balance between these two asset classes, between equities and fixed income? Is there fundamentally, balance rate that a healthy market should have?
It's a tricky question, because I think from my experience, I've seen that the participation of different levels, different classes of investors varies, right? Depending on, for example, the risk return. So pension funds naturally will tend to have high allocation for fixed income, I think, from the Kenyan context. But the question is the balance right? And also thinking about at an individual level, and also looking at what are their priorities, what are the investment priorities. So that informs the distinction between the proportions at which institutional investors allocate assets and those of, for example, a 25-year-old or somebody nearing retirement. So it will really vary. But at an aggregate level, I think the split for equities is quite low from an institutional investor standpoint. The allocation for equities is on the lower side. It tends to be about 20-25%. That there is certainly space to improve that to above 30%, and we've done so historically, particularly when markets were a bit more vibrant. I think that is the journey that needs to occur, moving from a very disproportionate allocation for perhaps fixed income and balancing it out equitably. Not just equities, by the way, but with other even emerging asset classes. For instance, the REITs, the real estate investment trust, that is another potential alternative asset class that investors should also look to, assuming these are well structured and brought to market, and in a way that will incentivize and inspire confidence.
Definitely. Yeah. I mean, listening at the president talking about, for example, the infrastructure bonds and the coupon rates that, coming in at highs of 13%. And he's a worried man also, but this is the market. And he's saying that very soon they'll be keen to not go above 10%. Yeah. In terms of looking at that particular logic, is it justified for starters wanting lower coupon rates so that we can see not over-investment into some of these fixed income assets? Is that justified from where you sit?
Yes, certainly. There is an important point that we can read from it, and I think when interest rate levels are quite elevated, that also means that investors will want naturally to be invested in, to take advantage of the higher interest rates, and that will mean other asset classes are sort of crowded out. Okay. So I think if the question is about what needs to be done to get investors to broaden their outlook, it also involves, one, solving that issue of having high or elevated interest rates. I think that is part of the conversation, and enabling investors on the other side to look at the other asset classes. But I think that balance does play out, and this is not a permanent situation. We've seen cycles. I mean, economies and markets will go through different types of cycles. So at this point in the cycle, that is perhaps what is happening, but it's not a permanent situation. Right. I think in the short to medium term, there's an opportunity for that to change, in the sense that you will have investors being keen on other asset classes, particularly if interest rates will not remain elevated.
All right. Yeah. So 2023 is here, very young, as it is, and with youth there is hope. I'm looking at the global economic projections for the year. Unfortunately, not bullish at all. Yeah, a lot of people saying there will be a global recession. How do we prepare for that, especially as a market? How do we create buffers. Yeah, I know you've spoken about local investors. At least focusing on that, it helps stabilize the market when there are a lot of turmoils globally. But apart from that, how do you prepare for that?
How to prepare for a recession? So globally, there's talk of recession in certain markets, and that sometimes does have trickle down impacts even for us. And I think the question for investors is how well or how cushioned they are in their portfolios. So I think the question is maybe or the point is to take a step back and think through the asset selection. I think, as I said earlier on, asset selection is very crucial.
Yes.
That investors remain diversified and think through, also have a long-term view, because I think, as I said, these are cycles that do come and go. But I think if you spot a good assets that will somehow perform through the cycles, that is also very, very crucial. So I think investors have to just generally be also positive and think through and not miss opportunities because of a situation that is likely to resolve itself in a short duration of time. I think there are lessons that we've seen that, for instance, when share prices are this low in the market, it's also an opportunity for people to think through the opportunities they can take for themselves before things turn around, because when the turnaround happens, it also happens rather quickly.
Yes, definitely. Segue, yeah? We've seen a move by government to push privatization. Yeah.
Correct, yeah.
And hopefully that also trickles down to come into listing, because we've had quite a dry, IPOs are not there and everyone is asking what exactly is happening. Now, on top of that, all these forces globally that are not favorable for the market. In terms of privatization as a vehicle to sort of spur this engine of the market, is that a viable part of the solution?
Yes, it is. I think it is also time to excite the markets. I think it's a very welcome and exciting time to hear about the forecast to reinvigorate the market through potential new issuances. So it is very important to also do so with the right sort of issuers that will come and have the right, or we will stimulate the right kind of reception by investors. So I think that is part of the solution that is required to help get us back to vibrant market conditions.
Wow, yeah, lovely. Looking at some of the parameters to measure market health, and I think we've covered that in the course of our conversation, how we can boost market depth, looking at the regulatory environment. But one of the issues has been transparency. I think we've made strides, but there's still more to be done. Talk to us about, based on these key indicators, looking at market depth, access to foreign exchange, 2023, which one will really shape the Kenyan market?
Yeah, I think certainly investors need to look at various things beyond the return potential of the investments they are considering. They'll also look at, for instance, the corporate governance environment and with respect to the listed companies. So I think it is one of the parameters that investors will look at carefully. I think there are definitely global shocks that will continue to impact how investors invest and allocate risk to frontier markets, including Kenya, and that remains a source of concern, particularly because these global shocks are still with us today.
Okay. Yeah. So 2023, are you bullish, are you bearish, or you are giraffish? You're just there.
Maybe I'll use the term cautiously optimistic.
Yes.
In the sense that I think the global shocks are still with us in some shape or form. The country is navigating some tough macro fiscal challenges, and the question is how well we'll navigate these. But certainly there is a reason to be positive, because as these situations are never always permanent. There will be some silver linings along the way.
Okay. All right. Thank you very much, Gregory. Gregory Waweru, the Chief Executive Officer of SBG Securities Kenya. The ins and outs of what to expect for the year 2023, and he says that he is cautiously optimistic, and so are we. Well, we leave you with the markets.